This video will help you understand the 2024 tax updates that are applicable to most situations. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. So every year, the IRS updates their tax limits or income ranges that permit certain moves, and this year's no different. In preparation for 2024, however, I thought it'd be helpful to get the word out ahead of time, so at the end of 2023, so that you can adjust any withholdings, your W-4, speak to HR proactively, etc. In addition, if you like to get everything done ahead of time as it pertains to funding certain accounts, then the faster you know this information, the faster you can make an informed decision. Now, of course, we're not going to cover every tax update, and we're going to keep it a little bit high level to the extent that I can. That way it's not as boring as talking about taxes can be. But then also, too, if you have further nuance or questions, it might make the most sense just to speak with a tax professional. The SEC and FINRA do not consider me to be considered a tax professional. So with all that out of the way, let's jump in. So first up, federal income tax brackets and capital gains tax brackets. We're actually not going to jump into this. One, because it's incredibly boring, but then two, there's a lot of minutia, and it would just make more sense to look at the schedule yourself to see which income ranges fall in between which brackets. And they only really matter if your income has changed drastically since the year before, or you're doing any sort of tax projections, which probably would happen more so at the end of the year. Also, I think the numbers are like 40 to 60% of US taxpayers actually don't pay any federal income tax, so this might only apply to half the population out there. Let's focus on the controllable, major moving financial pieces. So up first, 401k contribution limits. So this also applies to 403Bs, 457Bs, also known as deferred compensation plans. You are permitted to fund your 401k, 403B, or a deferred compensation plan as a pre-tax or a Roth contribution, regardless of your income. Now, whether or not your particular employer will permit such a move, that's a different question. I'm seeing it more adopted, but it's not necessarily a given. And of course, if you're self-employed and you have a 401k, you'll just need to check with your plan document. So the maximum for 2024 is the employee is allowed to make a salary deferral of $23,000 if they're under the age of 50. This is up a little bit from 2023, which was $22,500, but the catch-up contribution of $7,500 for folks who are 50 or older, that hasn't changed. And so for folks who are 50 or older, your maximum contribution limit is $30,500, which is the $22,500 plus the $7,500 catch-up. Now remember, the Secure Act 2.0 that came out at the end of 2022 mandated that moving forward, any sort of catch-up contributions that are made, which applies to those who are 50 and up, those have to be considered a Roth contribution if you're considered a highly compensated employee. Now, there's a caveat to this rule we'll touch on in just a second, but highly compensated employee in the IRS's mind was anybody making 145 grand a year. Now, they say as adjusted, which means that that number can go up over time. But essentially, if your compensation is over 145 grand, you would be considered a highly compensated employee. Any catch-up contributions you make would have to be made into a Roth retirement plan. Now, the IRS recently released Notice 2023-62, which said that there's essentially another 2-year administrative pause on mandating this. So you're in the clear until 2026, but just know in the back of your mind as you're doing your long-term tax planning, any contributions you make that are catch-up contributions eventually will need to be Roth if you're a highly compensated employee. Now you can still fund the rest of your retirement plan as pre-tax if you wanted to, or you could just keep it simple and just do everything Roth and not worry about it. But just know that there is a little bit of nuance when we get to 2026. All right, moving on past the normal contributions to 401k plans, let's talk about the after-tax 401k. And this one might be a little bit more math heavy. If your company permits an after-tax 401k, also sometimes called the Mega Backdoor Roth 401k, which I did a video on this a while ago, I'll link above here too. Think of it like a third bucket in your retirement plan. Most people are familiar with either being able to fund their retirement plan as pre-tax or Roth with a certain percentage of their income. But now, a number of retirement plans are allowing an after-tax 401k contribution bucket. The after-tax 401k contribution bucket essentially functions as another Roth 401k, and we'll describe how that works in a second. The math to figure out the maximum you're permitted to fund into that account, like I said, it's a little bit math heavy, there's some calculations to do, but essentially the way you do the math is you take the defined contribution limit, which is the maximum permitted that anybody can have go into their retirement plan in any particular year, which for 2024 is $69,000. Then you minus out what you're already putting into the regular 401k, either pre-tax or Roth. You take that total and you minus that from the $69,000. Then you further minus out any sort of employer matching contributions that go into your plan. And the result gives you the maximum you're permitted to fund into the after-tax 401k. Now that $69,000 defined contribution limit is only applicable to those who are under 50. If you're over 50, then you're allowed that $7,500 additional contribution. And that math equals $76,500. So just keep in the back of your mind, your after-tax contribution amount may or may not change depending on how old you are. Let's cover an example, and for that, we'll jump to the whiteboard.
All right, so we've established that the 2024 defined contribution limit is $69,000. This is the maximum that can go into somebody's 401k plan in any given tax year. In addition, the IRS implements a salary deferral maximum, which for 2024 is $23,000 if you're under the age of 50. Now, the IRS doesn't care if you do this as all pre-tax contributions, all Roth, combination of the two, doesn't matter. You as an employee can maximally fund a retirement plan at $23,000. Now, in this example, we're just going to assume that there is no retirement plan matching. So the math here is pretty simple. $69,000 minus what you put in as the employee equals 46 grand. This is your after-tax 401k maximum contribution. Now, if you're 50 or older, remember you get an additional $7,500 that you can put into your plan, right? Which equals a total of $30,500 that you can put into the plan. So now the math is $69,000, but in addition, your defined contribution limit goes up by $7,500, right? So rather than $69,000 being the maximum, it's actually $76,500, right? So now the math we do is $76,500 minus the $30,500 that you are permitted to fund into the retirement plan equals the exact same number, 46 grand. Now, the reason it says the exact same number is because you added an additional $7,500 up here, but then you also took away that $7,500 by funding your 401k with it. So the after-tax maximum is the same.
Now, the math in this case is the same regardless of how old you are, because that additional $7,500 that you're allowed to put into your plan, you're just putting into the regular 401k. So it doesn't change the after-tax 401k amount. Where it would change is if there is an employer match, and specifically for companies like Microsoft that match half of your contributions, if you make a catch-up contribution, your employer match is also higher, which actually decreases how much you can put into the after-tax 401k compared to someone who's under the age of 50. Now, one more logistical reminder, if you do have access to this plan, generally you'll have a drop-down list after deciding how much of your compensation you want to allot to that after-tax 401k that asks how often you want to do Roth conversions. Boilerplate recommendation is to get them done as soon as possible. And that's because any money that doesn't get Roth converted and stays in the after-tax 401k, technically the growth on that portfolio will be considered income taxable to you in retirement unless you do a Roth conversion as quick as possible. All right, so let's move on to IRAs. So the IRA contribution limit actually went up, which is great, to $7,000 with a $1,000 catch-up contribution if you're 50 and older. So again, the catch-up contribution didn't change, but the overall limit did. So if you're 50 and up, your maximum is 8 grand, assuming your income allows you to qualify to fund a Roth IRA. And those income limits also went up. So if you're single, the modified adjusted gross income brackets are $146,000 to $161,000. If you're married filing jointly, your brackets are $230,000 to $240,000. Now you might be wondering, why is there a range? And that's because for those folks whose modified adjusted gross income falls within that range, they are permitted a partial Roth IRA contribution. For some more nuance on that, you can check out a previous video, I'll link above here on that, because essentially the math works out to be whatever percent into that range you are is how much you're not allowed to fund into an IRA. So it's a little complicated, I'd check out the video. And remember, regardless of your income, you are allowed to fund a traditional IRA. So even Elon Musk and Jeff Bezos can fund traditional IRAs. However, whether or not they can take the tax deduction, which is usually the primary reason people like funding traditional IRAs, that's going to be dictated based on your income and whether or not you have access to a retirement plan through work. And those folks would be called active participants if you're going to do some Googling on this. To keep it simple though, if you have access to a retirement plan through work and you make too much money to fund a Roth IRA, you definitely can't fund a traditional IRA and take the tax deduction. All right, so moving on to Social Security. For those who are still working, if you're not retired yet, your Social Security taxable wage base is $168,000 for 2024. And as a refresher, this is the amount of income that Social Security is allowed to tax you on things like FICA taxes, or if you're self-employed, SECA taxes. Anything above and beyond that is not being subject to Social Security taxes. Now, that doesn't mean you're off the hook for payroll taxes. You will always have Medicare taxes on top of this, and FICA or SECA taxes total to 15.3% of your compensation. If you're self-employed, congratulations, you get to pay all 15.3%. However, if you are employed, your employer is going to pick up half the tab for that 15.3%, and then you'll pick up the other half. Now, Medicare tax, on the other hand, there is no limit on that. So regardless of how much money you make, you're always going to pay 1.45% of your compensation towards Medicare. In addition, based on compensation, if it's high enough, you might actually pay some additional Medicare charges of 0.9%. And this does not even factor in net investment income tax, which some people just call the Obama tax, of 3.8% for those folks whose compensation or investment income is high enough. We'll cover net investment income tax in a future video. We're going to skip past it today. From an estate planning standpoint, the lifetime gift exemption or estate tax exemption is now $13.6 million. I've covered in future videos why you might want to plan for something closer to about $7 million, but for now, the exemption amount is $13.6 million. That's the same with generation skipping exemptions as well. Segueing in the estate planning space to the annual gift tax exclusion amount, this is the amount of money that any individual is allowed to give any other individual without it reducing that $13.6 million lifetime exemption. And that number is $18,000, and that's up from 2023. So if you think you're flirting with that $13.6 million estate valuation, keep in mind, you can give $18,000 to as many people as you want to, as many years in a row as you want to. And generally those numbers increase every year. Let's talk about some medical stuff and then we can wrap up. So first up, health savings accounts. The maximum you're permitted to contribute to a health savings account for 2024, if you're single, is $4,150, and if you're a family, your maximum contribution is $8,350. And if you're 55 or older, you get a catch-up permission of another $1,000. Now remember, in order to take advantage of funding an HSA, you must be enrolled in a high deductible health plan. You're allowed to maintain your health savings account whether or not you're still enrolled in a high deductible health plan, but in order to fund one, you've got to be in a high deductible health plan. And if you're curious, if you're on TRICARE, you can't fund an HSA. Now, why does the HSA even matter? We'll touch on this in another time, but essentially, any money you put into the HSA gets an immediate tax deduction. Any money that grows inside the portfolio of your HSA gets all tax deferred gains, and then any money you pull out for reimbursing yourself for unreimbursed medical expenses are all tax-free. And you can take those tax-free withdrawals when you're in your 30s, 40s, 50s, or just bank all this for retirement, where I promise you'll have plenty of medical expenses. And that's usually the strategy we recommend. Pay medical bills out of current cash flow, fund the HSA, get that money invested into something simple, let it compound, and then bank all that tax-deferred future health reimbursement money for when you're in retirement. In the tax year of 2024, if 2 years ago, which would be 2022, if your income was higher than 103 grand as a single person or 206 grand as a married filing jointly couple, you get to pay more for Medicare Parts B and D. And IRMAA stands for Income Related Monthly Adjustment Amount. Again, we'll cover this in a future video, but just know if you make a lot in retirement or you show a lot of taxable income, you'll get to pay more for Medicare, which helps everybody else pay less. So calls to action. I would review the percentages that you're contributing to your employer-sponsored plan, if you have one, and adjust accordingly. If the limit went up by more than your compensation, then you're probably gonna need to go make some adjustments to your percentage that you're withholding. Vice versa, if the contribution limits didn't go up as fast as your income, you might end up over-contributing, which is fine, not a problem. Generally, your company will stop you from making too many contributions, so that in like November and December, your paycheck will look higher. And that's just because you've already maxed out your retirement plan. Or some 401ks will just plop extra retirement plan contributions into that after-tax 401k that we already discussed. And some employers will actually provide money into your health savings account for you if you're enrolled in the high deductible health plan. Keep in mind though, that reduces your total contribution amount. So for example, if you're a family who works at Microsoft and you're looking to max out your HSA at $8,350 for 2024, Microsoft provides $1,000 for free into your HSA, so your family contribution will be capped at $7,350 as opposed to $8,350. Sure, you miss out on taking a $1,000 tax deduction, but you also get $1,000 for free. So I'd much rather take the free money. but I'd review your percentages just to make sure that on a monthly basis, things stay hunky-dory. Another call to action, if you have your IRAs, for example, being funded as an auto contribution or your HSA, you might need to adjust those accordingly and make sure that the monthly contribution or quarterly or however often you fund these plans lines up with the new maximums. Or just create a fail-safe reminder in November timeframe to check in and see if you're going to underfund, like your IRA, for example, or if worst case, you're going to overfund your IRA. And then you can catch it before December and withdraw or remove any excess contributions plus the net income attributable. And if you don't know what I'm talking about, I've got a video on how to do that calculation, which I'll link up here. So the last call to action, but certainly not least, I'd schedule a time to review these updates with yourself and see if you need to make any adjustments to your financial plan. For our clients, we do that in March, and that's just because we're after the holidays, we're kind of getting into the tax mindset, and the IRS also doesn't push out all these numbers finalized until like December timeframe, and that's like the month after we finish seeing all of our clients in the fall. So schedule a time to review how these updates affect your financial plan. Hopefully that was helpful. If you have further questions or you think I might have missed something important, let me know. Drop them in the comments below, get in touch on the website, we'll get you squared away. Hope you have a great rest of your week, and if you're watching this in December, have a great rest of your year. Talk to you later. Bye.